Hey guys, how are you? Let's talk about options and trading them intraday. When to trade options, when to not trade options, what to look for when you're figuring out which options to trade. Okay, so first of all, you need to figure out whatever stock you're trading, go for it, go to the options chain and look at what the options chain looks like. Okay, is there activity? Is there volume? You need volume in order to trade. You need to see trading activity in the option. So if I'm looking at, say, here, let's pull up Roku since I had it on the chart there. These options expire in 1 day. I click on that and I can see that there's a lot of trading activity in this option today. You can see that's a lot of volume, hundreds of contracts. So generally, if you're going to pick an option to trade, you got to pick the one that has a lot of trading activity, okay? Because if you pick an option that has no trading activity, it's only going to be you and the market maker. And trust me, the market maker is not going to give you the price you want when you want to take profits, okay? So that's just the basic concept. So how to do this? Well, you need to look at what the volume is on your option, when that volume occurred, how clear the option chart is, and also just basically if there's any transactions coming into the market. You can see. So that's a Roku option. Let's say if I went to the next month expiry in March. Sorry, that was the wrong one. Let's see what these options are looking like. You can see there's volume on these contracts. But let's say if I go to the option with like a 5 delta, you can see that there's a little bit of activity, but not nearly as much as the shorter term options. So I think from a day trading standpoint, it might actually be better to trade the short term options. But the thing is that the risk in that is you need to be more conscious of the volatility exposure and the time decay exposure. So yeah, very important. So if you trade a later month option, keep in mind that there's most likely going to be less trading activity, which means that you are probably going to not be able to take profits at the prices you necessarily want to, because there's not always going to be someone on the other side of that trade willing to take it off you, right? So that's the basic concept, guys. And just understanding liquidity in market in the options market. Okay, so look at Apple options expiring next week. Look at how these are moving. They're flashing, everything's moving here. Even the options with, say, a 6 delta, yep, there's still some activity there. You can trade these options with a 6 delta effectively, I think. Now let's look at a different stock here, something less liquid. You can see these options, they have a few hundred contracts volume. Check the different expiries. You go to the next week options, they have much less volume on that. So if let's say I go to the option with approximately a 5 delta, or a 6 delta, whatever, and you can see there's no volume there. There's no open interest and no volume. Nothing's lighting up here, which means that nobody's trading it. And if you trade it, you're wasting your time and your money. So that's the basic bottom line, guys. Look, so I'll put up a contract. Yeah, you can see nothing's happening there. Don't trade that. Do not trade those options. Okay, so this brings me to the basic concept of, look, you can trade options with a small account, $500, $600. But the thing is that in order to trade options effectively and keep your risk managed, you need to trade options with a lower delta, like potentially between a 5 and 10 delta per contract, maybe even less if you're trading like Tesla or something. But the thing is, some stocks don't have liquidity with options of those deltas, okay? So again, this is an example. With CMG, you can see there's no liquidity in the out-of-the-money options. So there's no chance of you trading that with small capital. Look at Tesla, for example. Tesla options expiring next week. You can see the at-the-monies are very expensive. But let's say you had a $500 account and you wanted to trade this. You go to the out-of-the-money options, for approximately a 3 delta, let's say you're a 2 or 3 delta, you can see, let's say these ones, 1250. Let's look at what that chart looks like. And there is activity, you can see. There's some activity in there. And look at the time and sales. There's not a lot. I would prefer to find a more liquid option than that. So we can keep searching, in fact. If you go to the expiry of today, yeah, see, that's not really possible to do that. See, that's the thing. There's a lot of risk in trading these Tesla options, because if you look at volatility on Tesla, we're at like near 100% in IV rank, which means that the premiums are extremely overpriced based on the historical volatility. If I go to the March options, let's take a look at these ones. 1,500 calls. Let's see if anyone's trading them. And they're not so bad, look. These are the March options. You can see that in the morning there was some action here. There was some activity. So there's a higher chance that you can get filled. But the thing is, if you look at what the bid and ask is here, you can see there's only 30 contracts and 4 contracts on the other side. That's not what you want to see. You do not want to see that. Okay. So again, how to find options to trade? Well, you got to keep looking to find the ones with the right spread and the right amount of liquidity for you. Okay. Or else you just don't trade it. Spreads are wide. 1,300 calls on Tesla expiring next week. You can see there is a few hundred on each side, or at least 50. Bit of action there. So guys, if you like this video, please leave a comment below and keep your risk managed. Bye.